Hi everyone, welcome back to my channel Achieving Alpha. And in this video, we are going to talk about some of the most popular and highly profitable option strategies that you can use. So I'm assuming that if you're watching this video, you are familiar with the basics of options. If not, please go revise your basics and then come back to this video. So in this video, we are going to talk about mainly these strategies, and we are going to discuss the pros and cons of each strategies, when to use which strategy, and basically we'll build and simulate these strategies using an option simulation tool called Opstra. Now, most of these are option selling strategies, as you might be knowing that option seller has a statistical advantage over option buyers, but that's not always the case. So whenever we have high volatility in the markets, option buyers are having an advantage over option sellers, and in case of low volatility, option sellers have an advantage over option buyers. And most of the time market isn't that volatile if I keep aside the current scenario because of the coronavirus and everything. Market seems to behave strangely and there is a high volatility in the markets as of now, but I think option selling is where you're going to make most of your profits throughout the year, because markets are not that volatile throughout the years except for a few months. So I think we are going to talk about these strategies today, so let's begin. So let's first talk about call or put spread. Both have the same idea. So you are basically selling a call option or a put option and you are hedging it. So in this strategy, your market view is going to be directional, and this is a hedge strategy. That means you won't incur unlimited losses. So there is generally a belief in option selling that if you are selling options, you have the risk of an unlimited loss, but that's not always the case, because if you hedge your strategy, you have a limited loss and you have your defined losses. So there is not going to be any chance that you're going to incur an unlimited loss. And again, as said, this strategy has limited profits and defined losses. The range is not a problem as long as the market follows the predicted direction. It's fine for us. And you can avail margin benefits in this because you are using hedging. So let's try to create this and simulate this strategy in Opstra. So here I have opened Opstra, and we are going to simulate this for the upcoming expiry, that is the monthly expiry of Nifty, which is on 31st of December. So let's say that you have a view, or after performing certain analysis, now this could be technical analysis based on price action or based on option chain, you think that Nifty is going to expire below 14,000. So what you would do is that you would sell a call option of 14,000 for the upcoming expiry, but as you can see that the max loss here is undefined and you can have an infinite loss if a Nifty starts to go below 14,023. So what we'll do is we'll hedge this. So basically we can hedge this with 14,100, and this becomes your call spread. So as long as Nifty is below 14,013, you will make a profit of 1005, which is basically the premium multiplied by 75, which is the lot size for Nifty. And in case the market starts going above your break even, that is 14,013, you can have a maximum loss of 6,495. So this is what is call spread. Now I'm pretty sure that you must have guessed what is put spread. Let me show you that. Now let's say you have a view that Nifty is going to be about 13,500 in the upcoming expiry. So with sell a put option of 13,500, and again this is a naked put sell, this is a naked option selling. So basically you have an unlimited loss if the market goes against you. So all that you are going to do is just hedge it with a call option, with a put option of 13,400, and boom, you have your put spread ready. So as long as Nifty is about 13,491, you are going to have a profit of 716 on one lot, and the max loss could be 6784. So this was about call and put spread. Let's go to the next one. The next one is short strangle. So in short strangle, what you do is you sell an out of the money put option and an out of the money call option. We are going to see how this looks in the simulation. But for this strategy, your market view need not be directional and it is range bound. So you know that this is the weekly range for Nifty. And again, to find out the weekly range, there is one method based on India VIX and volatility. So I have a video on that, so you can check that out. And again, this is a naked option selling strategy, so there is a risk of an unlimited loss. So it requires a high margin because we are not hedging our positions. And it's a vega negative strategies. For so for those of you who are familiar with the option Greeks, vega if the Vega is negative, so basically it won't support volatile markets. A positive Vega supports volatile markets, and it has a positive theta. So again, for those of you who are familiar with option Greeks, you know that theta is your best friend as an option seller, because if the market stays sideways or if the market stays where it is, you are going to make profits because the option premium will decay as and when time passes. And again, this strategy is good when the volatility is low, or basically when India VIX has a value of lesser than or equals to 15. And you're going to get a maximum profit if the market settles within the desired range on the expiry. So let's see and simulate this one as well. So let's say we have a view, we continue with the same view that Nifty is going to stay below 14,000. So we sell a call option of 14,000, and we have a view that Nifty is going to stay above 13,500. So we sell a put option, and this is your strangle. So you can see that here we basically have this range from 13,441 to 14,059, and the maximum profit that you are going to make is close to 4,500 if Nifty stays within this range. But again, you can see that your losses are undefined. That is, you can suffer from an unlimited loss if the market starts going against you. So basically, this is a range bound strategy, and it's a non-directional strategy. We don't really care where the market goes as long as it stays within this particular range. So this was about short strangle. Let's talk about long strangle. So long strangle is basically the similar thing, but instead of buying these options that is sorry, instead of selling the options that we just sold, we can buy these. And this is basically what I've written: buy an out of the money put and an out of the money call option. And basically we use this when there is a surety of a big move in the markets. So this could be close to some important event, this could be elections, this could be a budget event, this could be a RBI meeting, or any such movement which can cause a huge movement in the market. The direction could be any, but there should be a movement if you want to be profitable in this strategy. And again, this as it's an option buying strategy, it requires less margin, so you only pay the premium for the options, and that's it. And again, it's a Vega positive strategy, so it will support volatile markets, and that's what it's made for. And it's a negative theta because as we are buying options, if the market stays where it is or if there is no movement, you are going to lose money. And again, this is good when the volatility is high or India VIX is greater than or equals to 20. So let me show you. So I'm not going to do much. I'm just going to change these sell positions to buy, and we have our long strangle ready. So as mentioned that if market stays between 13,441 to 14,059, now you're going to make a loss. And if there is a big move in the market, either uh, in the downwards direction or in the upwards direction, the direction doesn't really matter. Only thing that matters is that there should be a move. So you can create maximum profits, which is not really defined. So you can have unlimited profits if the market starts giving wild swings from here. So this is long strangle, and this is really good when you want to, when basically you are near some important event that can influence the market in any direction. Let's go to the next one, which is short straddle. So in short straddle, you are basically selling an at the money put option and call option at the same time. And again, this is pretty similar to strangle, where a market view is not directional and range bound. And again, these points are almost the same. It's a naked option selling strategy, requires high margin. It's a Vega negative strategy, positive theta, good when the volatility is low, and you get the maximum profit if the market stays near the strike price at which the call option and put option were shorted. So let me create this. So Nifty presently is at 13,749. So at the money is 13,750. So you short one lot of call option and you short one lot of put option. That's it. This is your short straddle. So basically you see that if the market expires at 13,750 itself, the maximum profit is going to be 16,000. That's what I showed in the slides, that if the market expires at the money, so basically that's where you make your profits. And again, you see that this is the range that you get, which is from 13,537 to 13,963. This is the range. And if I show you the Greeks, as I said, it's a Vega negative strategy. It will not support volatile markets. And the thing that I would like to mention is that you should never do this, uh, especially when you are taking the delivery of these options. And if there is a huge gap up or gap down the next day, you can suffer from really big losses. So you should avoid doing this. And since this is a naked option strategy, you should look for hedging, and that's what we are going to look next. So let me just talk about long straddle as well. So again, the same idea as short straddle. The only difference is that instead of selling the at the money options, you are going to buy them, and the rest of the points are same, and it's again pretty similar to your long strangle. So basically, when you have surety that there is going to be a big move in the market, you simply create a long straddle. Let me show you. I'm just changing the sold options to the buy ones, and boom, there is your long straddle. I'm sorry. So this is the range where you're going to incur losses, and if Nifty starts going below 13,537 or above 13,963, that's when you're gonna make crazy profits. So I guess we are left with the last two. Now this one is a really popular one, which is Iron Condor. So as I mentioned, that Strangle and Straddle are often unhedged strategies, and these can give you unlimited losses if the market starts going against you. So you should use hedging, and basically hedging a Strangle becomes an Iron Condor strategy. Now it's one of the most highly popular and profitable strategies for sideways markets, and it has a really high probability of profits and requires lesser margin as we are hedging our positions, and we get the maximum profit if the market is within the desired range, and this has a positive theta, and it's good when the volatility is low. So let's just create an iron condor. So again, as I mentioned, that iron condor is nothing but a hedged strangle. So let's do it. So we'll continue with the same view that Nifty is going to stay below 14,000 and about 13,500 in the upcoming expiry. And now basically you are going to hedge these put options and call options. So for 13,500 we can buy one 13,400 put option, and for 14,000 we can buy 14,100 call option. And this is basically your iron condor. So you can see that if market stays uh, from 13,478 to 14,022, we will be in profits. And basically, if the market stays between 13,503 to 13,996, we'll get the maximum profit, which is 1721. So this is basically iron condor, and it has a high probability of profit. The risk is to reward might not look uh, really favorable, but I think that this works most of the time, especially when the volatility is low. But this is just a particular example. The markets can be really volatile, as this is the last week of the year, so you should be careful. And let's talk about the last strategy, that is iron butterfly. Now this one is really good because it has a really good risk is to reward ratio, and basically when you hedge a straddle it becomes iron butterfly. Now it's again a really popular and profitable strategies for sideways markets, and it again has a really high sorry, it should be a low probability of profit. I'm sorry. So this has a low probability of profit, but if the market stays at the money, basically you are going to make the maximum profit, and which is going to be really good. And again, this has a positive theta and good when the volatility is low. So let's do this. So again, Nifty at the money is 13,750. So basically we'll create a straddle first of all. And now we basically can hedge this with a 13,850 call option and a 13,650 put option. So this is what it is, and as mentioned that the probability of profit is low, but if the market expires at 13,750, you are going to make a profit of roughly 6,200. And I think this is great when you are really sure that the market is going to expire near at the money, and at the same time you want to play the game with a very low risk. So you can see that the max loss is really less when compared to the max profit, and the risk is to reward ratio is again really great, but the probability of profit is really low. So do this when you are highly sure that the market is going to expire near at the money. So yeah, I guess this is another great strategy which you can try it out because the loss isn't that great. And yeah, I would say that these are all the strategies that I wanted to discuss with you guys, and I hope that this helps you because most of these are option selling strategies, and these are beginner to moderate level strategies. Now I do have plans on bringing some advanced strategies which you can use, and basically these are going to help you. So I hope you found this video helpful and you're enjoying the content. Please subscribe the channel if you are really liking the content, and please leave a like. It really motivates me to bring out more such content. So thank you so much for watching. See you in the next video. Bye bye.